We have a forecast for housing from the Canada Mortgage and Housing Corporation. They say the sector faces headwinds that will keep growth slow. Let's go to Kevin Hughes, Deputy Chief Economist at Canada Mortgage and Housing Corporation. Thanks for joining us today.
Thank you for having us.
What are the biggest challenges you would say affecting home building across the country?
Well, the challenges come from several areas. I think first and foremost, we have to speak about the quite high and unprecedented degree of uncertainty that we see in the economy, which is also apparent in housing markets for businesses, for developers, but also for our consumers, for households, and for those thinking of forming new households. That definitely has an impact. We can add to that lower population growth as well, as we know housing is very dependent on that, and as well income growth that is, let's say, modest recently, and carrying cost as well. So several headwinds. So we do expect, especially for construction starts in particular, that we are looking at slower pace for the next few years.
Okay, when you look just at the demand side, do you expect that then, for all the reasons you said, to stay low? And is that for rentals versus owners?
So that's in general. So if we go by market segment, obviously, and of course we're talking about the country as a whole when we look at different sectors of the country, Ontario, for example, as opposed to Calgary, for example, or Montreal, there are differences there. But generally speaking, we have challenges on the demand side, job security being one, carrying costs I mentioned. Prices are still relatively unaffordable, despite more supply. The rental market has been an area where we've seen more construction, and we've seen as well, according to our rental market survey, an easing of those markets. So, for example, currently Toronto, we're expecting around 3.5% vacancy rate, which will probably be the same next year as well. So some respite there for renters, but still we're talking about marginal gains.
Okay, let's talk a little bit more about the regional differences, because Toronto, you do see more rental starts. Why is that?
Well, it's been a segment that has been definitely outperforming the condo segment, for which is oversupplied currently. And so, multi-unit development in Canada is definitely, the main source of construction. Roughly 80% of starts are in multi-unit, especially apartments. So for several years now, that construction has been motivated by relatively sustained migration. We know that we have lower levels right now, and also probably less household formation of young households as well. So that's taken some pressure off of demand, and so even though the rental segment has outperformed, we do see that also slowing down.
Okay, let's get to BC, of course, with its key Vancouver market. What do you see happening there?
So we see Vancouver's resale market going kind of back into balanced conditions. So not more favoring suppliers that are like demand or supply. Stable prices, starts will go down, and the vacancy rate is let's say notably higher than in Toronto. We're looking at around 4% vacancy rate for the next 2.5 to 3 years. Calgary is going back from quite a strong market, bit of moderation, less migration there as well. Sales will also be stable there. And here we see the impacts of quite strong rental construction, because the vacancy rate is around 6% in Calgary.
Okay, let's get to a region that you see perhaps building above the average. Where are we looking?
Well, when we compare let's say those four major markets, Toronto and Vancouver, certainly those that will be slowing down the most, and those who will be more resilient, we're looking more at Calgary and Montreal. However, even Montreal, we're looking at slower population inflows for migration, rental market that is still easing as well, and so demand will be going down there. But here we're looking at a bit more resilient market. We have to consider too that when we're talking about construction in Toronto, we have quite a lot of very high rises compared to Montreal. That adjustment is much slower. And so, that just the composition of the market has an impact on how fast it adjusts.
And Montreal has been on a real build out of rentals.
Well, Montreal is the largest rental market in Canada, and rental demand has always been, a feature, and it's still. I mean, you could say that for the rest of the country, but definitely it has been strong. As we say, it will be also coming off a bit of pace this year, which is what we observe elsewhere. One thing to note, I think, when we look at the economy and how that impacts the housing market, is that right now, I mentioned, we all see this and observe this not only in the numbers, but in when we talk to the industry and look at our survey results, there is that uncertainty. But at the same time, the potential there is present, potential for economic growth and potential for people re-entering the market. Right now, the uncertainty is such that many actors are just holding off on those decisions. Should the environment improve even this year, that could have definitely some impacts in the outlook that we're, and adjustments that would be needed from the outlook that we're publishing today. So we are, in the last 2 years, we've been publishing a mid-year review adjustments, and so we'll be doing that again this year. So a lot of eyes on the macro economy for obvious reasons, and how that exactly will be influencing businesses, but also households and consumers. Governments remain really the source of growth this year, so we're forecasting just under 1% GDP growth, and that will be largely due to the major government infrastructure investments that have been announced.
The build outs. All right, Kevin Hughes, sir, thanks for joining us. I very much appreciate your time.